Hi, I'm Julian EC from BSB FM22, the 6th reporter of the Group 5, and my topics are the continuation of stocks valuation and the first part of bond valuation. Under the stocks valuation, we have the determining expected return, the price earning approach. Also, we have the price relative procedures such as the price to cash flow ratio, the price to sales ratio, and the price to book value ratio. Yung first is yung determining expected return. Minsan yung mga investors, they find it more convenience to deal in terms of expected return. Yung expected return can be found using the internal rate return approach or yung IRR procedure. This approach to stocks valuation uses the forecasted dividend and price behavior, along with the current market price to strive at the fully compounded rate of return you can expect to earn from a given investment. Para makita natin kung paano i-compute yung stocks expected return, we have the table 8.3. Makikita natin dyan yung the stocks current price na $41.58. We can determine the expected return. Hahanapin natin yung discount rate that produces a present value of future benefits equals to the price of stock, and magkakaroon tayo ng expected return of stock. Ganito kung paano siya i-compute. Using the universal example, yung stock is expected to pay per share dividends of 0.18, 0.24, and 0.28 along over the next 2 years. At the end of that time, we hope to sell the stock for $93.20, given that the stock is currently trading at $48.58. So, hahanapin natin yung discount rate that will produce a present value equals to the $41.58. Ito yung formula niya. Kailangan natin i-solve yung discount rate or yung the present value interest factors or yung PBIF na makikita natin sa equation na to. Kung gagamitan natin yung calculator, malalaman natin na ang interest factor niya is 31.3%. The present value of the future benefits from this investment equals to $41.58. At ayun yung expected return natin, yung $41.58. Next is yung price earning approach. Ito yung tinatawag na intuitive approach or yung alternative approach of the stock valuation. The price earning approach is a favorite of professional security analysis and is widely used in practice. Using this equation and solving for the market price of the stock, we have the stock price is equals to EPS times price earning ratio. Along with the EPS, we now have the price earning ratio we need to compute. The price at which the stock should be trading. For example, a stock that's currently trading at $37.80 1 year from now, it is estimated that this stock should have an EPS of 2.25 per share. If you feel that the stock should be trading at a ratio of 20 times projected earnings, then it should be value of $45 a share. So, tinimes lang natin yung 2.25 times yung 20 na ratio. Next, yung other price relative procedure. In addition to the price earning approach, there are several other price relative procedures that are used by investors. Yun nga yung sinabi ko kanina, yung price to cash flow, price to sales, and price to book value. Yung first one is the price to cash flow ratio. The procedure is almost identical to price earning approach. Yung price to cash flow ratio is combined with projected cash flow per share to arrive at what the stock should be trading. This procedure nonetheless has one problem defining the approach cash flow measure. The one measure that seems to be most popular with professional analysis is yung EBITDA, or the earnings before taxes, depreciation, and amortization, which we will use here. EBITDA represents cash earning to the extent that the major non-cash expenditure are added back to operating earnings. Ito yung equation niya. The price to cash flow ratio is equals to market price of common stocks divided by cash flow per share, where cash flow per share is equals to yung EBITDA divided by number of common shares outstanding. The computed price of shares of stock is equals to cash flow per share times the price to cash flow ratio. To illustrate, assume a company currently is generating EBITDA of 325 billion, and that is expected to increase by some 12.5% to around 365 million. Tinimes natin yung 325 million sa 1.125 over the course of the next 12 months. On a per share basis, let's say that translates into projected cash flow per share of nearly 6.50. Now, if we feel this stock should be valued at around 52 a share. So, next is yung price to sales ratio and price to book value ratio. Yung ibang company, mas gusto nila yung new technology or yung internet firms, kaya naghanap yung mga ibang investors ng iba pang procedure na based on sales tsaka book value. Yung book value is other term for equity or net worth. Yung mga procedure na ito is katulad lang nung previous na procedure, which is yung the price earning approach tsaka yung price to cash flow ratio. Yung equation ng price to book value ratio is equals to market price of common stocks over the book value per share. Katulad din nung price to sales ratio, it is equals to market price of common stocks over sales per share, where sales per share is equals to net annual sales or yung revenue divided by number of common shares outstanding. Generally speaking, the lower the price to sales ratio, the better. In fact, many investors look for stocks with price to sales ratio of 2 or less, as these securities are felt to offer the most potential for future price appreciation. Especially attractive are very low price to sales multiples of 1 or less. Kung iisipin natin, kung merong price to sales ratio na sabihin natin 0.9, na you can buy $1 in sales for only 90 cents. So there's a valuation rule to remember. High profit margin should go hand in hand with high price to sales multiple. That makes sense too, because a company with a high profit margin brings more of its sales down to the bottom line in the form of profits. We are done in stocks valuation. We will now proceed to bond valuation. Our learning objectives is to explain the behavior of market interest rates and identify the forces that cause interest rates to move. To describe the term structure of interest rates and how these so-called yield curves can be used by investors, and to understand how the bonds are valued in the marketplace. So, ano nga muna yung bond valuation? Yung bond valuation, it is a technique for determining the theoretical fair value of a particular bond. Bond valuation included calculating the present value of bonds' future interest payments, also known as its cash flow, and the bond's value upon maturity, also known as its face value or per value. The behavior of market interest rates. Rational investors trying to earn a return that fully compensates them for risk. In the case of bondholders, that required return have three components: the real rate of return, an expected inflation premium, and a risk premium. Thus, the required return on a bond can be expressed by the following equation. Ito yung equation 11.1. The real rates of return and inflation premium are external. The real rates of return and inflation premium are external economic factors, and together they equal the risk-free rate. Now, to find out the required return, we need to consider the unique features and prosperities of the bond issue itself. We can do this by adding the bond's risk premium to the risk-free rate. A bond risk premium will take into account key issue and issuer characteristics, including such variables as a type of bond, the issuer's term to maturity, its call features, and bond rating. For example, yung mga more conservative investors, they watch interest rates because of one of their major objective is to lock in high yields. Yung mga aggressive traders naman, they also have a stake in interest rates because their investment programs are often built on the capital gains opportunities that accompany major swings in return. Next one is yung keeping tabs on market interest rates. Just as there is no single bond market but a series of different market services, so there is no single interest rate that applies to all segments of the market. Each segment has its own unique level of interest rates. Some of the more important market yields and spreads are as follows. Yung una is yung municipal bonds. It is usually carry the lowest market rates because of their tax-exempt feature. Second is yung issues that normally carry bond ratings. Yung municipals or corporates generally display the same behavior. The lower the rating, the higher the yield. There is generally a direct relationship between the coupon and issue carries in its yield. In the municipal sector, revenue bonds yields more than general obligation bonds. Bonds that are freely callable generally provide the highest returns at least of date of issue. These are followed by deferred call obligation and then by the non-callable bonds, which yields the least. Bilang isang investor, kailangan mo mag-pay attention to interest rates and yield spread and try to stay not only sa kasalukuyang state ng market but also in the future direction in the market rates. For example, if you are a conservative investors and think that rates have just about peaked, that should be a clue to try to lock in the prevailing high yields with some form of call protected. For example, yung bibili ka ng bonds like treasuries. So, ano nga ba yung cost para gumalaw yung rates? Although interest rates are a complex economic issue, we do know that the certain forces are especially important in influencing their general behavior. Serious bond investors should make it a point to become familiar with the major degree of interest rates and try to monitor those variables at least informally. So, ano nga ba yung impact ng inflation sa behavior ng paggalaw ng interest rates? The behavior of interest rates has always been closely tied to the movement in the rate of inflation. There are at least 5 other important economic variables that can significantly affect the level of interest rates. Una is yung changes in the money supply, yung pagtaas at pagbaba ng supply ng pera. Pero kung yung growth of the money supply becomes excessive, it can lead to inflation, which of course means higher interest rates. Yung pangalawa is yung the side of the federal budget deficits. The increased demand for funds exerts an upward pressure on interest rates. Next is yung the level of economic activity. Ito yung mga businesses na kailangan ng mas malaki pang kapital when the economy expands. Next yung policies of the Federal Reserve. It is usually does to So by driving up the interest rates, unfortunately, such actions can be nasty side effect of slowing down the business activity as well. Next is yung the level of interest rates in major foreign markets. Yung investors look beyond national borders for investment opportunity. If rates in major foreign market rise, the put pressure on the rate is also to rise as well. If they don't, foreign investors may be tempted to dump their dollars to buy higher yielding foreign security. Next is yung the term structure of interest rates and yield curves. Although many factors affect the behavior of market, interest rates, one of the most popular and widely studied is bond maturity. The relationship between interest rates or yung yield and time to maturity for any class of similar risk security is called the term structure of the interest rates. This relationship can be depicted graphically by a yield curve, which relates a bond's term to maturity to its yield maturity at a given point of time. A particular yield curve exists for only a short period of time as market conditions change, so do the yield curve's shape and location. Meron tayong types of yield curves. Yung una is yung upwards sloping and yung pangalawa is yung downwards sloping. Sa upward sloping curve, it indicates that yield tend to increase with longer maturity. That's because the longer a bond has to go to maturity, the greater the potential for price and the risk of loss. Yung pangalawa naman is yung downward sloping, which occurs when short-term rates are higher than long-term rates. This curve generally results from action by the Federal Reserve to curtail inflation by driving short-term rates way up. Paano nga ba mag-plot ng curves? Yield curves are constructed by plotting the yields for a group of bonds that are similar in all respects but maturity. Treasury securities, yung bills, notes, and bonds, are typically used to construct yield curves. There are several reasons for this. Their yield are easily found in financial publication. They have no risk of default, and they heuristics. Plot the points on a graph whose horizontal, yung x-axis, represents time to maturity in years, and whose vertical, yung y-axis, represents yield to maturity. I-connect lang yung mga points na to para makakreate ng curve na ipapakita ko na yung example is yung figure 11.4. We have the explanation of the term structure of interest rates. As we noted earlier, the shape of the yield curve can change over time. Three commonly cited theories, yung expectation hypothesis, the liquidity preference theory, and the market segmentation theory. It will explain more fully the reasons for the general shape of the yield curve. Yung una is yung expectation hypothesis. The expectation hypothesis suggests that the yield curve reflects investors' expectation about the future behavior of interest rates. This theory argues that the relationship between the rates today and rate expected in the future is due primarily to investors' expectation about the inflation. If yung investors they anticipate higher rate of inflation in the future, they will require higher long-term interest rates today and vice versa. Generally, the expectation hypothesis, an increasing inflation expectation results in an upward sloping yield curve. A decreasing inflation expectation results in a downward sloping yield curve. And a stable inflation expectation results in a relatively flat yield curve. Next is yung liquidity preference theory. One explanation for the frequency of the upward sloping yield curves is the liquidity preferences theory. This theory states that intuitively long-term bond rates should be higher than short-term rates because of the added risk involved with the longer maturities. In other words, because of the risk differential between long and short-term debt securities, rational investors will prefer the less risky short-term obligation unless they can be motivated via higher interest rates to invest in longer bonds. Actually, there are a number of reasons kung bakit yung mga rational investors dapat mas prefer nila yung short-term securities. Unang-una, ito ay they are more liquid. Ibig sabihin, they are more easily converted to cash and less sensitive to changing market rates, which mean there is less risk or loss of principal. Next is yung market segmentation theory. Another often cited theory, the market segmentation theory, suggests that the market for debt is segmented on the basis of the maturity preferences of different types of financial institutions and investors. According to this theory, the yield curve changes as the supply and the demand for funds within each maturity segment determine its prevailing interest rates. Next is yung paggamit ng yield curve in investment decisions. Bond investors often use yield curves in making investment decisions. Yield curves change in accordance with market conditions. Analyzing the changes in yield curves over time provides investors with information about future interest rate movement and how they can affect price behavior and comparative returns. Ano nga ba mag-price ng bonds? Pupunta naman tayo sa pricing of bonds. Bond prices are driven by market yields. That's because in the market price, the appropriate yield at which the bond should sell is determined first, and then the yield is used to find the price or yung market value of the bond. The appropriate yield on the bond is a function of certain market and economic forces. Yung mga risk-free rate or yung return and inflation, as well as key issues and issuer characteristics, yung years to maturity and the bond rating. Yung unang way in pricing bonds is yung annual compounding. The following information is needed to value a bond. Yung number 1, yung size of the annual coupon payment. Second is yung the bonds per value. And the third is yung the number of years remaining to maturity. So, here's the equation. Bond price is equals to present value of annuity of annual interest income plus present value of the bonds per value. Or yung BP is equals to I times PBF IA plus PB plus PVIF. So, where yung amount of annual interest income is yung I, yung PVIFA is yung present value interest factor of an annuity. Yung PVA is yung per value of the bond, which is the assumed to be $1,000. And PVIF is yung present value interest factor for single cash flow. Next way is yung semi-annual compounding. In practice, most bonds ay nagbabayad ng interest every 6 months. So, semi-annual compounding is used in valuing bonds. Fortunately, it's relatively easy to go from annual to semi-annual compounding. Ang kailangan lang natin gawin is to cut the annual coupon payment in half and make the 2 minor modifications to the present value interest factors. Given these changes, finding the price of a bond under condition of semi-annual compounding is much like pricing a bond using annual compounding. Ito yung formula. Bond price with semi-annual compounding equals to present value of semi-annual coupon payments plus present value of the bonds per value. So, BP times yung I over 2 times PBIFA plus the present value and PBIF o yung present value interest factor. This is the end of my discussion. I hope you learned something about the stock valuation and bond valuation. So, thank you very much and good day.